So we're joined today by Nick Samoulihan from Aviva. Nick's a senior fund manager within the multi-strategy team at Aviva Investors, and also the joint fund manager on the Aviva Investors multi-strategy target income funds. Nick, thanks very much for joining us today.
Thank you.
I wanted to kick off, so clearly the team focuses on strategies which or aim for a specific outcome for investors. I wondered maybe to kick off, just go through what the actual specific target is for the target income fund.
Absolutely. The target income fund is designed, if you want, for today's world where clients require income, but either the old traditional route of putting it into a bank account just provides too low a level of interest, or instead going into other things like equities, etc., pays you either quite a lumpy income, or in some ways you're taking lots of risk with that. So what we've done is built a fund where the ambition is to pay whatever the Bank of England rate is plus 4%, aim to have that as smooth as possible throughout the year, and at the same time, over rolling 3 years, preserve capital. So in a sense, by taking a little bit longer term horizon and being more sophisticated outside, we can now offer clients an income solution which says, give us the money, we'll pay you a steady, smooth income on that, which is much higher than you get in traditional asset classes, and at the same time, we aim to preserve your capital over rolling 3 years.
So maybe if we take that income element first, what are the sources you go to try and generate that?
So there are only really 5 sources of income if you think it through. There are equity dividends, there is income from lending to companies, corporate bonds, there's income from lending to governments, so government coupons, there's rental income, so property through REITs, and then there's selling options. And most traditional income sources either have one, maybe at most 2 of those income sources. What we do at Aviva Investors is combine all 5 of those together for a complete diversified income solution. And we try and make sure that at no one stage any one source dominates, although we do skew it over time where the risk and income makes that sense.
Sure. So moving on from income, the capital preservation and the volatility target, how do you manage that?
Well, this is where the fund gets really interesting and actually is quite hard to manage compared to traditional multi-asset or standalone funds. The problem with getting income is as you get income from, say, dividends, you're taking equity risk. As you get coupons from government bonds, you're taking risk over their default. So what you need to do is firstly diversify amongst all of those. That's part of the solution. Then you need to make sure that while you build this portfolio, you take into account not only current correlations, but how those change over time. We have a third aspect to that. What we have is a range of strategies directly designed not to pay an income, some of them they do, not to generate a capital return, but instead the strategies are only there to preserve capital over rolling 3 years.
So those sorts of strategies are probably a differentiator for this fund compared to traditional funds. And maybe if you delve a little bit deeper, I mean, can you maybe give us an example of one of those strategies?
Absolutely. So at some point it's quite easy to protect a portfolio. All you do is you go out and buy derivative protection. The problem with that, as I'm sure many of your clients know, is over time that simply bleeds away returns. So what we've done is we've tasked every single person at Aviva Investors to say over the next 2 to 3 years, if our house view doesn't turn out to be correct, if something goes wrong, either the equity market falls, interest rates go up faster than expected, and so on, can you come up with an idea, some creative idea, which would normally not do anything in the portfolio, but if that scenario happens, it would protect the portfolio, so it would generate outsized returns. And we have a range of them, and we're quite proud of these. They're really creative ideas, and what they do is they sit in the portfolio, they don't really do very much, but then when they're needed, they kick in. So a very good example, and perhaps one of the more simpler ones, is we've got a position which simply plays the fact that in normal markets, so when markets tend to go up, large companies go up at a certain amount, but smaller companies, and the example we have is in the US, smaller companies tend to go up a bit more. So the beta is about 1 to 1.2. I think most people understand that. Now, if you think what happens, how do more people price that when there's turmoil, when there's a huge big sell-off? If there's a big economic event, smaller companies who are much smaller in terms of balance sheet, much more isolated in terms of their funding and their revenue, those companies usually fall much more than 1.2. So the beta changes. So what we've got is a very simple strategy which says long this, short that, in a ratio of 1 to 1.2. In normal markets, it cancels out. Whenever there's a huge negative market correction in the equity market or a growth scare, the smaller companies lose much more than that, and that strategy pays off. So it's simply paying, if you want, playing to the behavioural finance idea of during different regimes, people price things differently.
Sure. So I guess a crucial thing is how you construct that portfolio and manage risk within it. Maybe you could touch on that process?
So there's two things. One is the prism we approach this through, and that prism is to take every single strategy, every idea we have in the portfolio, and put it into three different types of buckets. And we call those market buckets, so market strategies. These are ideas which traditionally are long only, so we're invested in equities for income. On the other side, we've got opportunistic ideas. These ideas are not driven by a view that says the world's going over here. They're driven by things like we expect this policymaker to react, so completely independent of the broader macro picture. The third one is risk reducing, and those are the ideas we just spoke about. The trick is to make sure each three of those are balanced in the portfolio. The other aspect we do, sort of the quantitative work, is we've created a new kind of function. So most fund managers will talk about having a risk team, and we absolutely have a risk team that taps us on the shoulder and says, what have you done? We've still got that. We've added a new team though, and this team says that before we do anything, they will see the impact of that. They're part of the fund management team. They help us run these portfolios, help to meet client objectives, but they're embedded in the process to make sure that risk management is the starting point and not the end point of what we do.
Sure. Maybe to finish up, one question we ask all managers in the sort of due diligence process is just how well aligned they are with other shareholders. Right. Could you go into a bit more detail about how the team is aligned with?
Completely. So the AIM's outcome range at the moment is two funds. There's one designed to grow capital over time, so in your savings part, and there's one designed to pay an income, the target income fund. In terms of the actual alignment, almost all of us, I can't go into actual details because I don't know them, are very aligned to that. Take myself, for instance. If I was managing an equity fund, I could tell you that a part of my portfolio was invested in that equity fund and the other part was for diversification somewhere else. When you're running a fund like we are, where we say if it's a great idea, it should be in the portfolio, there's absolutely no reason why it should be anywhere else. So for instance, I'm entirely invested in the AIM Target Return Fund for my pension. I think it's the best proposition out there for my own money. So there's complete alignment in terms of that.
Nick, thanks very much for joining us. I appreciate your time. If you want any further details on the Aviva Investors Multi-Strategy Target Income Fund, please contact your broker for a copy of our recent research notes. Thanks very much.